This will destroy the economy. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, there's no chance the economy will survive this, as now a second half recession is a near certainty. I'm going to show you what's coming for the economy and why discretionary spending is outright going to crash, and any notion of a no landing, a soft landing, is going to go out the window once we realize that the second half of this year is going to face not just a recession, but a potentially severe recession. And of course, the timing of this is going to be outright horrible, as we're already seeing a slowdown in the manufacturing sector. And based on a new report we got today, we're now seeing it's actually far worse, much worse than we thought. But the government says not to worry. They think the economy is in great shape, and their latest report says that perhaps there's a ton of jobs out there, but we're going to show you why this report that government just put out is about near worthless. But you may remember a couple weeks ago we had a sponsor on our show, Edge TI. We mentioned at the time that they would be going public here in the U.S. We now have official word. I met with the management team yesterday. We're within 10 days of that happening. But here's the best part. We don't know what actual day it's going to happen. They don't actually know. But we promised you there's going to be a huge media blitz following this. Well, here's the good news. You now have a chance to get ahead of that media blitz. The symbol UNFYF. Again, Edge TI. Go check them out. UNFYF. When this hits the DTC, we're going to follow us up with a major press release and an announcement, and you now have a chance to be first. Let's over to CNBC, where we picked today's story up with a headline: debt ceiling deal would push student loan borrowers into repayment by fall. Now, this is a really important story because you think about where discretionary spending comes from, and all of a sudden, if everybody that has to start making their student loan payment again, where are they going to cut their spending from? Are they going to stop paying their rent? Are they going to stop paying for their groceries? Are they going to stop paying their energy bill? No, they're going to cut their discretionary spending, and this is a huge issue because what is everybody been pinning the hopes of this economy on? Not just China, but the services sector. You can better believe what's going to take the biggest hit. Well, that's going to be services. According to the legislative text of the agreement, the pause on federal student loan payments, which has been in effect for more than 3 years now and spanned 2 presidencies, will cease to be effective. Borrowers will be required to resume paying their student loan bills 60 days after June 30th. Their due date will likely be starting in September. So you can only imagine now, as we are perhaps days away from getting the bill. It's supposed to be going through the House today. It will then eventually get to the Senate and the president's desk. If the debt ceiling bill does go through, then what's going to follow with that is, you imagine, notices will go out to borrowers saying, guess what? Your payments are going to have to start resuming in September. Now, of course, we don't know if there's going to be a debt cancellation. That's still sitting in the Supreme Court, potentially up to $20,000 per borrower wiped out. But regardless, people are going to have to start paying again. And as soon as they get those notices and realize that this is coming, what are they going to start doing? Well, if you guess they're going to cut their spending and build up their savings, you got it. In the current version of the debt ceiling agreement, the pause would be terminated 60 days after the end of June. Get this, the U.S. Department of Education would also be restricted in its ability to extend this particular relief again, with another prolongment likely only possible from Congress. So any notion that borrowers could get some immediate relief from this a second time, not a chance. That's only in the hands of Congress. Of course, we know Congress doesn't do anything until they absolutely have to, and even then, they don't do it at all. The Biden administration has warned that resuming student loan payments without being able to carry out its debt forgiveness plan could trigger a historic spike in defaults and delinquencies, and this is just stating the obvious. In a period of high inflation, where we know rents and energy and food prices have far outpaced what wages have gone up, you start to see people then having to add this back to the budget, and there's absolutely no way they're going to pay on it. A lot of people are going to just stop making payments altogether, and those delinquencies will roll into default, and it will just create a gigantic mess in the financial system. And it's just a whole another idea of here we go again. But the reality is it's going to be back in September. The Biden administration is pending regulatory changes to student loan repayment would also not be impacted by the deal, including implementing a new repayment plan. This plan could lead borrowers only to pay 5% of their discretionary income toward their student debt each month. Now, if that were to happen, of course, that would be great news for a lot of borrowers. That gives them some of a stop loss in how much of their income can go to debt service. However, if you imagine that all these student loan borrowers that has to start going down their spending expendable income down by 5%, and you think about how that's going to affect the broad economy, it's going to have a major impact. And that is the problem here, is the economy in the second half this year is going to face a force of deceleration due to a lack of spending, particularly discretionary spending, and at this point, it won't be stopped. But the debt deals to hit the U.S. economy is already facing a recession risk, which could give the Fed an excuse to pause at their upcoming June meeting. Federal spending in recent quarters has helped support U.S. growth in the face of headwinds, including a slump in residential construction, and the debt limit deal is likely to at least damp that impetus. 2 weeks before the debt deal, economists had calculated the chance of recession in the coming year at a whopping 65%. And now we're saying this is a near certainty when you start to factor in that all these student loans are going to have payments back on them, and particularly it's going to be even worse. Can you imagine being one of those people that think that if that $20,000 is wiped out, that they may not have any payment? If that doesn't go through the Supreme Court, that all of a sudden they could be forced to pay as well. It's going to have a broad-reaching impact on the entire economy at a time now that we can look at this budget and know that government spending is going to slow. The spending limits are expected to be applied starting with the fiscal year beginning October 1st. So here you can see in September what happens. Student loan repayments start and goes into October with everyone having to adjust, and then at the same time, less fiscal spending. It is a perfect storm for the second half of this year, although it's possible small effects will emerge before then, such as clawbacks to COVID assistance or the impact of phasing out forbearance towards student debt. Those would be unlikely to show up in the GDP, however. But one of the challenges we're facing here is that this is going to happen, and it's going to be a bad news for the economy. But one thing it shouldn't affect is your trading account. As we've been talking about with our CTA-Timer Pro, this huge rally in tech stocks, you could have bought in here, you could have bought in there. It gave you 2 signal points. And some of you are saying, well, how will we know? If it's so great, will you show us when it reverses? Okay, we'll do that. But for the moment, look at this. On January 9th, what did it tell you? That major short covering started to begin by the machines because we run a historical overlay. So it tells you when things are deeply oversold, where you want to re-enter them. It gives you some signals to run against your own and tells you these are the times. Here it is on March 15th. We see the machines after that move down starting to buy back, started giving you all the signals you needed to know when to start buying, to run your signals. You want to know what reverses? We'll show you that. In the meantime, $30 a month, link in the description below. You'll find out it's one of the most accurate reports that you've ever seen. Even so, with spending in the coming fiscal year expected to be held around 2023 levels, what restraint the deal does impose would kick in at a moment when the economy might be in contraction. Economists surveyed by Bloomberg previously penciled in a 0.5% annualized drop in GDP for both the third and fourth quarters. And this is an issue I brought up in the show the other day, is you start to look at this and say, what happens if we get into a recession? Now, all of a sudden, you want to see an increase in government spending. That's kind of how the system is designed to do. The government tries to offset a decline in economic activity, but now you're going to see it hamstrung. So you see the force coming. You see student loan payments have to restart in September. You're seeing now that fiscal spending will be limited starting in October. We hit a recession, and the government won't be able to respond in the traditional sense. Again, we'll have to go back to Congress, which we've talked about. Doesn't do anything till they have to, and even then they are unlikely to do a whole lot until they really are forced to do it. And the timing, as I said in the intro, is terrible because we're seeing a downturn in the manufacturing sector. We just got a report today from the Chicago area, the Purchasing Managers Index, and it was downright horrible. It was so bad. This isn't just recessionary levels. This is actually way worse than that. Here we can see the Chicago PMI printed at 40.4. Now, the experts said it was 47 was what was supposed to come in. Now, remember, 50 is unchanged. At 48 and below 50 says it's slowing down. A 40. When you get to 45, we talked about this on the show before, you're at recession level data. Now we're seeing a 40. This is what you call a severe contraction in the economic data. And you start to look at crude oil. Remember, we talked about that yesterday. Look at the response in crude oil today. It just came dumping down to 67. Here we're facing upcoming OPEC meeting where they're looking to cut, supply to the market to try to raise prices. And the oil market is telling us this great leading indicator that, look, something is severely wrong with the global economy. Demand for energy is plummeting despite efforts to cut production and to limit supply. It's in big trouble. Now, does this mean the Biden administration will start buying crude oil now that's under 70? I'll let you weigh on all this. What do you think of all the student loan stuff? Do you think it's a good idea that people have to go back and repay? Do you think we should suspend it more? Do you think the Biden administration will start refilling the SPR to put support under the oil prices? Let me know in the comments below, because now let's go back to China, what we talked about yesterday, as we have now data, this from the Wall Street Journal, as a recovery slows further as factory service activity pulls back. Now remember, this wasn't supposed to happen. What did we hear from China? Everybody's putting the whole global recovery pinning on China. We said, look, if demand slows down, the factory sector there is in trouble. The manufacturing data, now we're validating that. Everyone said not to worry. We got the services sector. Nope, not for long. An official gauge of the country's manufacturing activity slipped unexpectedly to 48.8 in May, falling deeper into contractionary territory, even as the broader economy has been unshackled from 3 years of strict COVID zero restrictions. So what have we been saying? That the global economy is really weak. There's evidence of it in the yield curves. And all of the data is suggesting there's a major slowdown coming. Validated now. The demand out from the world's largest exporter is telling us demand from around the world, from where goods go to, is low and getting worse. The official gauge of the non-manufacturing or services purchasing managers index, which covers both service and construction sectors, remained in expansion territory, but pulled back to 54.5 in May from 56.4, noticeably telling us a slowdown and about to turn around. Taken together, the weaker than expected numbers on factory and services activity point to tepid and short-lived, what we've been saying, post-COVID economic rebound. We said, look, this is all going to turn the other direction, but the government says not to worry. Our report today says the U.S. economy perhaps is the cleanest shirt in the laundry basket, and perhaps even stronger than everyone thinks, but maybe it really isn't. As U.S. job openings surged to 10.1 million, upping the odds for a Fed hike. Of course, market didn't like that and sold off on it because nobody wants more rate hikes other than, of course, the Fed. The number of available positions increased to 10.1 million from an upwardly revised 9.75 million in March. This, of course, suggesting that businesses want to hire and want to hire lots of people, particularly heading into the summer season. We talked about that on the show the other day, that businesses want to hire, but people aren't spending. So is this just, heading into summer seasonal data? Well, a lot of it has to do with the stock market. And here you can see the relationship between the JOLTS and the Wilshire 5000 or total U.S. stock market. That's shown in red. And what we note that with the lag, usually job openings tend to follow the market higher. And we kind of suggested this would happen. Last month, they had a big decline in job openings. So it was no surprise that this month's data, it kind of bounced up a little bit. But from the Fed's perspective, as they head into their meeting in the middle of June, I believe the 17th is a Thursday is when they meet. This is giving them more ammunition for a rate hike, because we know that at least former Fed Chair Janet Yellen's favorite report was the JOLTS survey. Of course, her protege is in office right now. That is Fed Chair Powell. So if she liked it, there's a good chance he does, and could weigh into another hike. Demand for labor has remained largely resilient, even though tighter financial conditions have forced some employers to hit the brakes on hiring. While job cuts that began in white-collar sectors, including tech and banking, are starting to spread to other industries, some companies are still struggling to find workers. But what's odd about this is, and we'll get the new data tomorrow, is we see, of course, continuing claims holding around 1.8 million. So if all these job openings are real, then my friends, you tell me, why aren't people taking those jobs? Why are we seeing so many people still sitting on continuing claims? It's hard to say, but the real issue is, as far as an actual useful report, well, this report, this JOLTS, it's terrible. Here you can see the current general activity diffusion index for Philly Fed. So we'll go to the manufacturing sector here against the JOLTS, that in red. And what do we know? You can be in a deep contraction in the data in terms of the manufacturing sector, and with a long, very, very long lag, do you see job openings come down. So let's not put any stake on this other than the algos trading the market who didn't like it at first. A lot of people look at this though. The problem is, so does the Fed, but it won't matter, because once these student loan repayments come back, and once the new fiscal policy from the debt ceiling bill goes into effect later this year, what you're going to see is a massive deceleration of spending into that, and by the fourth quarter, it's game over. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.